Okay, Chris, thank you very much for coming to this conference.
That's a pleasure.
Very interesting talk about soft risk and hard risk. So what's the difference?
I suppose there isn't a sort of scientific definition of either a hard risk or a soft risk. They're concepts I introduced into my talk to make a particular point about a particular approach to measuring risk and a quantitative approach to risk management. So an example of a hard risk would be something like market risk, where there is a lot of historic hard data about movements in past market prices, for example, that makes that kind of risk amenable to a particular type of modelling and a particular approach to risk that involves setting limits, establishing adequate capital levels and so on. Whereas on the other hand, a soft risk is something very different, much more nebulous, much more fuzzy. Reputation risk would be the classic example of a soft risk, where data is very sparse, at best anecdotal, and an approach to risk management certainly can't involve limit setting, it doesn't involve capital adequacy. There's much more emphasis on judgment rather than pure quantification.
So I was about to ask, what's the trick? How do you manage?
How do you manage a soft risk? Well, I think you do it at two levels. One is sort of at a very high level, very much sort of the culture of the firm, the tone that senior management sets with regard to a soft risk. So for something like reputation risk, the first step is certainly recognising that reputation is a very, very valuable asset of the firm, and therefore that reputation risk matters. But it's how senior management translate that into decision making that matters. So if people come to senior managers asking for decisions, asking for approval for investments, if in that conversation executive management frequently ask questions about what will this do for our firm's reputation, or if something goes wrong, what would it do to the firm's reputation, that sends a very important signal to employees that reputation matters, and when they've received that signal they pay some attention to it. But at a different level you can also manage a soft risk like reputation in a more analytical way. So for example, for us as an asset management firm, there are really two things that matter to us, the two things that could really harm our profitability. One is the performance of the funds we manage, and the second would be anything that triggered very large-scale redemptions out of those funds. So you can easily make visible to people the effect that a major reputational event would have on the attitude of our customers and what that would then do to redemptions and so to profitability of the firm. And you can focus quite resolutely on those kinds of processes that matter for our reputation with our customers. So processes that make sure that we're selling suitable products to investors, and processes that deal with the way in which we value funds under management, processes that manage conflicts within the firm or help to ensure that we look after our customer data carefully.
Right. Okay, no, thank you for that. And maybe final questions. Man Group has been a success story over the last 7 years, so you guys are doing something right, which is great. Still, I mean, have you guys learned something out of the crisis?
And you always learn things as you go along, whether in good times or in difficult times during a crisis. Certainly, and while our liquidity management worked extremely well during the summer of 2007, and in fact the demands for liquidity for Man Group as a corporate entity were lower during that period than they had been 12 months sooner. We've certainly learned that there are refinements we can make to our approach to liquidity risk management, refinements to the scenarios and some interactions of particular types of events that we hadn't necessarily thought through fully in advance of the crisis. And above all, I suppose, sort of developing the story that goes with a liquidity scenario. It's very much around the narrative and putting people in the position that they can imagine themselves in circumstances where the crisis is happening and the kinds of decisions they have to take in the crisis, how they prioritize particular uses of liquidity. That the story matters at least as much, if not more, than the actual numbers themselves.
Right. Chris, thank you very much.
Thank you.